Before I start, I want everyone to look out the window. It is the most incredible day out there, and again, thanks to Rex and the folks at the Golden Gate Club for putting this together. And if you'll look out, it's just like a really nice day, right? So I want to let you know, behold, because this is the beginning of a golden age of fintech. You are here at the moment where this is like the dawn of the golden age of fintech, right? And so you see all these folks who have come through today and given these great presentations. Laura and Jason in particular were both really, really good, and Jack's going to come up next, and smart. And you look at this and you're like, there's some real intellectual horsepower going on here, right? There's some real financial horsepower going on here. Like, there is a ton of excitement about this space and about what people are building, and I think that's super interesting and exciting. So I'm going to spoil the mood and talk about incumbents for a little bit, okay? So if you'll bear with me, I want to show you the website of the Bank of America, okay? So if you go to this website, you'll notice it's like a choose-your-own-adventure story. You know, the Bank of America believes that you as a consumer are supposed to show up at their website and then do this thing that they told you to do. You're supposed to like click on a credit card and then go get it, right? And as a customer, you know, I don't maybe some of you have actually gone through this flow or done this thing before. I find that it's not the most compelling activity in the world to go to some website and then have someone tell you to do something, and you're like, well, do I really want to choose the card that works for you? You know, what do these stars even mean, right? So this is what retail banking looks like today. This is what incumbents look like today. And so what does retail banking look like tomorrow? Well, I think it's much more exciting. It's more about, hey, let us do that thing. So at Trim, my name is Thomas Smyth. I'm the founder and CEO of Trim, and we are a financial health company, okay? So we help people to improve their financial health. They pay us in order to benefit from that. So it's a very simple company, all in all. So one of the things that we do is we negotiate people's cell phone bills and cable bills. And we think that this is basically what retail finance looks like, what retail banking looks like in the next 5 or 10 years, is that you are paying a financial health company to solve your financial problems, right? You're not going to your bank's website or some bank's website and having them tell you to get some credit card that improves their margins and allows them to stack on a little bit of revenue and additional fees, right, with little to no benefit to your bottom line. So this is exciting, and I think there is increasing convergence. There is an increasing sort of zeitgeist in the space, that there's an understanding around where we are going as consumer fintech, where we will end up, and also, unfortunately, where incumbents will end up, right? And so one of the things we've thought about a lot at Trim, and Jason certainly has thought about this quite a bit as well, is like, hey, as there is convergence around this idea of the UI that automates your financial life, you know, this whole experience of everything from savings to credit to retirement, all is going to be done for you. You just sort of opt in, you know, to switching bank accounts, right, to have that be done for you. That's all very exciting, and I think everyone ends up there. But the question is, to me, what makes the innovators win? How can the innovators get enough Americans to use these new and exciting products before the incumbents, you know, buy some of them or build it themselves, or to Jason's point, maybe it'll take 5 years, right? But ultimately, you've got a lot of big banks and a lot of big balance sheets that are very interested in maintaining this customer relationship, even if they end up looking more like a Trim than they do like a Bank of America website today. So that's kind of what I want to talk about. So again, the convergence, what the retail bank is going to be in 5 years is a financial health provider. So it will be doing planning for you. It will sort of power your advice and budgeting. It will help you on the spending side. This has been our primary focus at Trim, is helping folks with their expenses to reduce those, whether that's subscription management or negotiating your telecom bills. It'll help you save. So we actually just launched a savings product. This is basically the same thing as Capital or Digit, or there are a bunch of other folks in the space. And it'll help you to borrow, so finding appropriate credit, doing this easy, I mean, this is Tally, right? It's doing this easy payoff and minimizing your APRs. And then finally, insurance, and I thought a bunch of the stuff that Laura was talking about is super exciting. switching to the right insurance at the best price. And this is all happening in the background, right? So again, this to me is like table stakes. This is like everybody knows this is going to happen. And the question is, who's going to get there and who's going to get all the customers to do this? And is it going to be the old guys or the new folks, right? Or the innovators? So what we do at Trim, I'll spend a minimal amount of time on this, and mostly as a recruiting pitch. So we are hiring, especially a PM. And I know there's some PMs in here. So if you're looking for a job, call me or email me after. So what we do is we transform Americans' financial health, right? And so we're focused on building this hub for your financial health. So we offer advice, we offer bill negotiation, we offer the account aggregation, we just launched a savings product, we do subscription management, and on and on and on and on, right? And you can sort of imagine, I mean, heck, based on the other 5 speakers today, where we're going, what our roadmap is, and where their roadmap is as well, right? And to me, that's actually very exciting that there is that sort of convergence or zeitgeist in space. So we've been growing pretty quickly. We're coming up on 500,000 users. We've raised close to $10 million, and we're very focused on the unit economics. So we think that a lot of this growth needs to be propelled by unit economics that are positive in order to like have a long-term sustainable company that has many millions of users. So, and there are 12 of us, and again, we're hiring. I don't know if I mentioned that, but we'd love to add number 13. So in the future, everyone, right, will say that they're a financial health company. And again, in that world, like, how do you figure out who is and who isn't? Like, what does that mean? Like, when Bank of America and Lending Club and Tally and Affirm and Trim, they all say they're financial health companies. Well, some are and some aren't. We're not going to be the only one, by the way. Other people are doing really good work and will continue to do so. But I think the question is, like, how do you, what will distinguish the folks who are actually working for inclusion, the ones who are actually working on behalf of the customer, versus those who aren't? And so we have sort of an interesting answer. So again, talk is cheap, right? You know, Wells Fargo, where I remain a customer since the age of 15, continues to screw the heck out of all of its existing customers. And one of the most interesting things to look at is, this is the former CEO, this is on an earnings call a couple years ago, talks about how his customers are sticky. The question was, hey, looks like you have a ton of deposits. Why don't those get up and leave? And this guy says, oh, it's because our customers are sticky. The next time you hear a bank executive talk about how their customers are sticky, find and replace sticky with dumb and lazy. Okay, so this is what Mr. Stumpf is saying here, is that my customers are so dumb and so lazy that they aren't going to get up and move their deposits, despite this, right? So these are the Wells Fargo rates today. It's like, what the heck? Well, like, in what world do we live in where you can offer, you know, literally 1 basis point to your customers and still be sitting on like $1 trillion of deposits, right? And so I kind of think about this and think about this and think about this and try to go, well, where do we go with this, right? Where do we go? And so the way I think about it is that ultimately, if you are a bank and you have a big balance sheet, the way for you to make more money is to either offer less money to your depositors, right, or charge more money to customers who come and bank with you with a variety of products. That's kind of it, right? That's kind of it. You know, either they can pay less on the liability side, or they can make a little bit more on the loan book side, or charging fees works too. And that's like fundamentally different from the business model of some of these new fintechs, and fundamentally different from the business model that we are trying to build at Trim, where instead, if you're a financial health company, we make more money when we make people more financially healthy. Right, so I just think there is such a radical difference in the business model of someone who is sitting on the supply side, someone who is managing that balance sheet, someone who makes money off of balance sheet operations, versus a service provider that is getting paid by the customer to improve their financial life. Because if we don't improve people's financial health, then they leave, right? Then they don't pay us, they don't tell their friends about us. Whereas if Mr. Stumpf doesn't improve any of Wells Fargo's financial health outcomes for their customers, they're sticky, right? They're sticky. So how long does that last? When does that arrangement start to break down? And I think it's in the next 5 or 10 years. So anyway, the takeaway today that I have, and I hope you all will take with you, is that in the long term, it's much, much better in this internet world to bet on the customer, not the balance sheet. So if you're an extremely talented product manager or engineer thinking about your next job, if you're someone from the existing financial services world who's thinking about where to make partnerships that will grow over the long term rather than deteriorate, if you are someone in working for an incumbent, I'm sure there are a couple incumbents here, and I mean no disrespect to you, but I would think about the course of your professional career over the next 5 or 10 years and the course of the decisions you're making inside of your organization and the decisions that your organization is making at a broader level, and think, hey, where's your bet? Is it on the customer, or is it just on some piles of money sitting, allegedly in a vault somewhere? That's a really big difference, right? That's a really big difference, and that leads you to very, very different outcomes. And I hope there will be more and more bets coming on the side of the customer, and that is what is going to change this ecosystem, right? That is what is going to transform the world of retail financial services over the next 5 to 10 years. So, thank you so much. Again, my name is Thomas Smyth. And thanks everybody for having me. Really exciting. And I think we have time for 1 or 2 questions. 1 and a half questions. A short one and a long one. How about that? Anyone? Yes. We're tiny. Yeah.
500,000 customers is pretty nice. I wish I had that. But so you can grow by acquiring customers and focus on the customers. But as you become a full financial health company, you're eventually going to be required to grow without growing customers. So aren't you just going to become either in charge more, or, you got to grow your margin somewhere.
Yeah, super interesting. So let's play this thought experiment out, right? So let's say 100 million Americans-ish, right? 100 million households. And you acquire all of them, and they all pay you I don't know, let's say 10 or 20 bucks a month.
Okay.
Great.
But you think the banks didn't say that when they started too? When Wells Fargo back in 1852 or whatever it was said, oh well, if I get all of San Francisco, I'll be comfortable and I'll stop trying to grow.
Yeah.
I don't think anyone sits there and goes, oh, I want to screw the customer that 150 years from now.
But how do you grow ARPU? It's basically the pressure you're looking at over time, right? So you're saying, hey, look, it's great that you would have all these customers and they would all be paying you some monthly fee, but then how do you double from there? If you're looking at a domestic, I think it's totally fair. So let's say financial health is sort of a spectrum, right? And so a lot of people in America are starting down here, and they would pay a fair amount of money to get to here. What does this look like? I think your point is very well taken, actually. What if you stop thinking about the savings? What if you get everyone in America and you figure out their savings first, right? And you figure out their spending, and you figure out how to pay off their debt, and then you figure out how to get them set up for retirement. What do we do after that? How can you make people financially healthy after that? Help them make more money, maybe? I think there's unlimited upside in America, and unlimited upside over the long run for the American consumer. And I think making a bet on long-term financial health and then financial prosperity, right? That's only upside in terms of ARPU for our company and ARPU for companies across the board. Yeah.
Thomas, so you talked about consumer-centric versus balance sheet. I love that, actually.
Fee-centric, let's call it.
Okay, good.
Consumer-centric, fee-centric. Yeah.
I'm just curious why you haven't made the switch all the way to a platform where you might have others, and you mentioned a few of them, Tally and others who might coexist with you. Would a platform play be more beneficial, even more beneficial for value being created?
Yeah, it's interesting, and there's sort of an ongoing strategic discussion, I think, happening in a lot of companies. What we see is that companies that are going direct to the consumer and owning the customer relationship tend to be worth a lot more. And the platform play, where people are doing B2B stuff and so forth, tends to be a fallback when you don't have the unit economics to support sustained acquisition of consumers at scale. So it's a little bit of a heuristic. I'm not fully answering your question, but basically what we see in the space is everybody goes out and they try to do the direct-to-customer thing, the direct-to-consumer thing, and then the ones that, there are exceptions, obviously, but typically the platform play tends to be a little bit, you're able to capture less of the value. Yeah. Okay, cool. Thank you all so much. Really appreciate it.